Hello, everyone. Today on the final bar, my guest is TG Watkins from Simpler Trading, joining us to tell us about his Moxie indicator, what it's pointing to with a couple key technology stocks you want to pay attention to. Oh, the overall market certainly finishing stronger, really through the balance of the day, with the S&P up 1.6%, closing with authority above the 3,600 level. What does this mean in the shortened holiday week about the long-term trends? What we should expect next week and beyond? Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. This is Dave Keller, your host, Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close as we look at these markets together through the lenses of technical analysis, behavioral finance, investor psychology, sentiment, decision-making, breadth, momentum, whatever we can do to try to make sense of the market in uncertain times. As we mentioned in the introduction, S&P certainly pushing further to the upside. It's a familiar sector distribution. You look at energy, financials, materials driving the way higher. And, again, with something like energy, I'm asked after energy gaps up that first gap higher. I remember being asked that day, did I miss it? Like, was that it? And I was like, well, big moves usually start off as a start. There's a starting point. And what you've seen with this drive higher with energy, just because something is up multiple percents a day doesn't mean it can't continue in that direction. This is the essence of trend following, is to identify trends, to follow those trends, and then to anticipate when the trends are over. And I think what the good news is for energy stocks, for financial stocks, for the big banks, you have some pretty clear risk levels in mind if you just pay attention to the charts and continue to bump up your stops reasonably. We have some great guests on the show. I'm excited to have TG Watkins join the show for the first time in a little bit. We are going to take the rest of the week off for the Thanksgiving holiday, so hope you and can celebrate with those around you safely. And we will see you again live on Monday. Coming up on December 1st, which is next Tuesday, we have Sean McLaughlin from Trade Ideas and All-Star Charts. And then on Thursday the 3rd, we have Ari Wald from Oppenheimer coming back on the show. Some really, really good guests to help us make sense of these markets. Let's get to our market recap. We're going to start with a bit of a poll. We always have a poll running on our StockCharts TV page. I'd encourage you to throw in your votes anytime you can bring that up. Recently, we asked you which outcome feels more painful to you, either missing out on a stock that goes up 50% or holding a stock that goes down 50%. And 80% of you pretty much confirmed what's called prospect theory, which is that the pain of losing hurts a lot more than than missing out on something to the upside. That losing, the idea of having something and losing it, is way worse than missing out. The FOMO. Even though, as the market's going higher here, we certainly have the fear of missing out, suggesting that investors are piling in. They see these gains, and you're nervous about missing out on further upside. But overall, when the reason why that's an interesting poll question is if and when at some point the market turns down again, which I'm told is likely to happen at some point in our future. When it does, that's when the pain starts to be pretty palpable. And even though we've had potentially locked in plenty of gains, when the pain starts coming, it tends to be difficult to hold in there. Let's continue on with our market recap. As I mentioned, the S&P up 1.6%, closing around 3635. We've talked about that key 3600 level for a while now, for a couple months. And this is, again, another attempt to close above that 3600 level. As I've mentioned before, it's all about the follow through. And we've had attempts like this before that we've not seen the follow through. Something feels a little different now in terms of the individual price charts that are really breaking out to the upside in consumer, in energy, in financials, in materials, in industrials. There are a lot of places with a lot of stocks going up. And so the question is that enough positive breadth to push the major averages higher? The NASDAQ lagged behind, but just by a bit. Technology did okay and kind of hung in with the overall market, underperformed by a bit, but overall in pretty good place. The VIX back down below 22 again. Looking at some other asset classes, bonds weaker today with the TLT down 1%, 10-year yields back up to around 88 basis points. Metals continue to get really crushed on the downside. A couple, pretty bleak days for gold and silver, continuing that rotation lower. Continuing on with cryptocurrencies, Bitcoin rising above 19,000 here with the close just above the 19,000 level. 20,000 is sort of that big glass ceiling that we've thought about for Bitcoin for a while. Will have enough upside momentum to push through that potential resistance level. Let's start with gold, actually. When we think about these different asset classes, we'll look at a chart of the S&P, but gold gap down today, looking at the GLD, and the GLD is back down to its 200-day moving average. It's been above its 200-day moving average since March, and that was just a brief sort of break below. After that, it resolved back to the upside. Gold's really been in a 3-month sell-off after making new highs in August. So it peaked out before the S&P, before stocks, before other asset classes. It's kind of rotated lower. It had that low in September, bounced off of it, and now continuing to break down. It's now broken down through the last Fibonacci support level. If you take the 61.8% line, that's retracing this June to August rally. The March to August rally says that the first support is right around 171, 171.50. We've broken that as well. So a gap down below those key support levels. This 200-day is sort of the last line of defense. If you break down that, I think you get. I think you're aiming down at 157.50, which would be a 61.8% retracement that would completely retrace down to the June lows. It would be a pretty major change from the rally that you saw in July into August. But that's certainly what the trend has been. Again, breakdowns like this shouldn't be that much of a surprise on a trend that has been lower. You've seen lower highs and lower lows. Yesterday really closed in a position of weakness, breaking down through that September low, and now we're getting the follow through. The question with anything like this is that last gasp low, or is that final move, that ultimate move before we see some appreciation? Right at the 200-day is an important place to kind of revisit that. Looking at the S&P 500, right, this range that we've talked about for the longest time, this may be it. I will say the same thing I said here in mid-November when we closed above 3,600 level for the first time. This is the second time now. The question was, do we get enough of a follow through? Now that we've eclipsed 3,600, this level that we focused on for a while now, do we have enough upside momentum to push us higher? And each other time that we've tried to get above 3,600 and stay there, it's been repelled and we've moved lower. Now, this week we have the added benefit of the holiday weekend, the holiday week here, with limited trading, a little lighter volume in general. This tends to be flat to up, if anything, and that combined with the news on the presidency potentially getting closure with Biden in the driver's seat going into next year, maybe that is enough with the breadth improvement to push stocks to further highs. For me, I don't tend to think a lot of or put a lot of weight on dramatic improvement during a holiday week, just because it tends to be a lighter volume experience. Going into next week, whether, see where we close this week, see if we get the follow through going into next week. I think that could certainly suggest a much stronger tape going into year end. And again, based on individual stocks, you certainly see the strength there. Worth noting, the S&P not overbought yet, still down around 63, 64 on the RSI. So we haven't had a explosion to the upside that has taken us to overbought conditions. Hasn't happened yet. So certainly some room to grow on the S&P, and it's all about whether or not we get the follow through to the upside and continue on. Looking at sectors, so what did not participate in the move today? And again, on a big, a strong up day when things overall are appreciating, it's good to know what led. And again, it's energy and financials really driving things higher today. But what was not part of this gain? Real estate notably was flat. Healthcare, really just a rounding error above zero. Consumer staples, utilities, these are sort of the four laggards out of the group, and then it got closer and closer to the market return. So some sectors certainly not participating. Healthcare is an interesting one. As much as we've seen upside in stocks like Moderna and others for obvious reasons related to vaccines and so forth, overall as a sector, it's not been the best place. And if you look even at biotech, right, some of the biotech names look very strong, but a cap-weighted biotech REIT, if you look at the IBB, it's not great. And especially it's okay. It's not bad. I mean, the chart isn't horrible. It's not breaking down, but it's certainly not outperforming. And the relative strength is what's most concerning there. The trend overall has been negative since mid-May because the big gains came sort of March, April, May. And from there, it's sort of been sideways on price. the relative strength has overall been skewed downwards. We're close to making a new, 8-9 month relative low for the IBB relative to the S&P 500. So overall, it's just not been a great place. The RSI is right at 50, by the way, which just drives home the fact that on an absolute basis, the group has not gone anywhere in 4 or 5 months. It's essentially right where it was after the rally into the May high. So while other things have appreciated, have emerged, things like financials and energy, healthcare has essentially been stagnant, and biotech as well. Now, having said that, there are individual stocks and individual groups doing much better and performing pretty well on a relative basis. But as a broader look, it's not been the better place to be. Finally, I just want to point out in terms of groups and themes, there are a lot of groups that did very well today. Too many for us to really go through. I'd encourage you to look at the scooter rankings and see which stocks appreciated. You'll notice things like Apache, Cruise Lines, CCL, AAL. We talked about Royal Caribbean yesterday. CCL is in a similar position now, gapping higher, breaking to new swing highs. Airlines, as much as I hesitate to suggest airlines are a good trade given the fact that we're in the middle of a pandemic, the charts continue to go up, and it speaks to optimism. It speaks to resilience of these names and expectations that things are going to improve. But the airlines group up almost 6% today, outperforming handily. As always, look at the bottom side. Gold stocks and mining stocks struggling. Home construction as well, and that's worth thinking about. Home builders have been sort of left behind while other things have appreciated pretty well. So if you're still there in some of those names like Lennar, D.R. Horton, and others, Toll Brothers, I would certainly check those charts and make sure you have a good risk assessment in place. We need to take a quick commercial break. Back with my guest, TG Watkins. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We really appreciate you joining us every weekday after the close to look at the charts together, try to make sense of these markets. Love to answer your questions. We're going to do another mailbag segment a little later in today's show. We'll do another one at the beginning of next week, and we would love to answer one of your questions live on the air. A couple ways to get your questions to us. Number one, via email, thefinalbar@stockcharts.com. Number two, on Twitter, just tag us in a comment at FinalBarSCTV. Finally, on our YouTube channel, just put a comment right below the video you're watching. We'll capture all of those, and all the questions we're going to hit a little later in today's show have come from all of you in the last 24, 48 hours or so. So keep the questions coming. We love to help you navigate these markets as you go along your normal process. I want to welcome on my guest, TG Watkins. TG is the director of stocks at Simpler Trading. He's done a really good job and has been well received hosting your Daily Five, which is one of our other Stock Charts TV shows. TG, pleasure to have you on, and thanks for joining us.
Yeah, much appreciated. Thank you.
So we have a couple charts. We're going to lean into technology a little bit, and I it's interesting. So much has been paid attention to things like the value trade, financials, energy, and you're sharing us some examples in the technology space. I think are pretty compelling. Take it away.
Yeah, Riot is actually more of a blockchain or Bitcoin related stock. What has been interesting is you got a couple other ones like Mara and then, Ethereum that trade in relation to Bitcoin. And what we've been noticing over the last several weeks is that Bitcoin was just on fire and on a roll. Now, usually these two stocks follow each other pretty well. At least Riot follows Bitcoin pretty well. But what we noticed is leading into earnings for Riot, it just wasn't doing anything. But I kept thinking, hey, this is bound to work at some point. So I kept a really close eye on it. And a couple of things started to occur. So one, we started getting into a squeeze, which at the bottom of your chart there, you can see the red dots. That means it's a high compression squeeze. And a squeeze is when the Bollinger Band gets inside of the Keltner channel. This is kind of like what I call about the calm before the storm. It's high compression. It's like, okay, things are gearing up, getting ready to pop and explode. But it doesn't tell us when, and it doesn't tell us which direction. And then that's where my proprietary indicator, the Moxie indicator, comes in. And what you can see there is when it was crossing from below the zero line to above the zero line, we got those Moxie price triggers up above on the price chart. And then I waited till after earnings. We got the typical double bottom that you look for in price. The 8 EMA was over the 21 EMA. That's the blue over the orange. and everything just started to look great. I sent my subscribers into this. We started piling in, and then almost out of the blue, this thing just shot up one day, and it went from something like, I don't know, 10 million shares on average to 82 million shares in one day, just absolutely huge. And that went up 50% that one day. And I said, hey guys, we're having a pretty good run. Some people are getting nervous. Like, do we take some chips off the table? And I said, when you go from 10 million shares a day to 80 million shares a day, this thing's got some juice. It's going to keep going. So this is kind of an older slide, but we held on to it. We started getting out of it yesterday and today at about $7 for about a 96% gain in just a handful of days, and just loving it so far.
It's a great example. You touched on so many things there, TG, but I love this idea with the Squeeze Pro. It's about the compression, right? It's about the lower volatility, which tends to precede a breakout. And then I like the idea of using the Moxie to actually get the directional indication of what's happening. Example 2 is with apps. Walk us through this one.
Yeah, now this one you can see we have the daily on the left and the hourly on the right. Now, maybe if you guys are just familiar with looking at charts, you can kind of see the squeeze happen anyway. You can see the last couple days on the daily chart, very kind of narrow, compressed, not much going on. But what's nice is to actually have an indicator that just blinks and screams at your face. And that's what the squeeze does. And you can see it's noted there at the bottom again, nice and red. It's telling us like, hey, something's building here. There's some pressure. There's something going to happen. And again, when is this going to fire? Where is it going to go? Which direction? We don't know that. That's where you come in with the Moxie indicator, and you can see that it went from negative to positive. It populated on the price chart with those green arrows, and it got over all the moving averages and then just started to take off. And I led my subscribers into that one just before that move. Now, once again, this is just a couple days old of a chart, and where price is now is right back down to where our entry is. It's right below that magenta colored line, kind of where the arrows are. And then this is what I call a trampoline move, because the Moxie indicator is actually telling us that the momentum and energy is still positive, even though price is down. This, if anybody's out there looking at this and maybe looking tomorrow and stuff, this isn't a recommendation, but this is a pretty good spot where I typically find a buy is when price is back down below the 50 SMA, that purple line, but the Moxie indicator is still positive. And I'm telling my subscribers to be hanging on to this pullback and say, hey, that might actually be a good dip buy.
It's a really interesting example. I'm curious which we have a minute for a question, TG, but I'm curious if you could talk just a little bit about how you relate the daily and the hourly, right? Combining two different time frames. A lot of people struggle a little bit with how to deal, especially with like a conflicting message. What happens if one is telling one is telling the other? Can you just summarize, how do you deal with those two time frames together?
Yeah, I actually use 3 time frames often, but my bread and butter is the daily and hourly. And what I do with this is I kind of refer to it as the snake. Like, you think of the head of a snake. In order for price to get going someplace, the head of the snake has to then move where it wants to move, and the rest of the body follows. So there has to be some place that price finally starts. And for me, that is typically the hourly chart, because you just don't always get enough clarity or precision with the daily chart. You see the bigger picture, but like, when's it going to go? That is when I then zoom in with a little bit more of a microscope, look at the hourly chart, and then I get that precision of just before this thing fired, you could see price actually did the double bottom, which you probably wouldn't. You can see where that orange line is just left of the green arrow. There's a double bottom there, up above on price. Yep. And yep, right there. And you can't really see that on the daily chart, but you can see it on the hourly chart. And then you can also see how price couldn't get past the hourly 50 where that double bottom was, and then it did. And that is what I'm talking about. That's the extra little clarity that I can see that gives me the precision. That's why I balance, okay, the bigger picture is this daily chart looks great, but when do we actually do it? And that's the hourly chart.
I love that combination. TG, this was a pleasure to have you on. Thanks for walking us through those examples. Have a wonderful holiday. Hope you and those around you stay safe, and we'll talk to you again soon, all right?
You too. Thanks for having me on.
That's TG Watkins. He's the director of stocks at Simpler Trading. We have this Squeeze Pro indicator on ACP. It's part of the StockCharts Advanced Indicator plugin, and I was excited to talk with TG about how he actually uses that. I love that sense that it's, or the idea that it's a sense of volatility, whether volatility is increasing or decreasing. We're really looking at the movement in the name, and then using other tools to try to qualify breakouts and start to measure from there. Really interesting stuff. Let's get to our next segment, which is the Final Bar Mailbag. So as I mentioned earlier, we love to hear from you and very much appreciate the opportunity to answer your questions and point you in the right direction as much as we can. So here we go. Question number one, is there anything to take away from the 20, 50, and 200-day moving averages all crossing over at the same point? Is that a super golden cross? Which I love that question. It's not. I've never heard that before, and we may take that, Kevin. Thank you so much for the question and the suggestion. I'll try to get that to take with my peers, the technical analysts in the industry. But your question is this. This is one you sent CF, and you're looking at this example here, which is this something to be said when they all cross? So, there's it's sort of yes and no. Is there a methodology of looking at multiple moving averages and when they cross? Absolutely. Is there a technique looking at more than two? Absolutely. A lot of people call it a moving average ribbon, where you have a bunch of moving averages and you're looking at when that whole shape crosses up and down through one another. Rick Bensinger, who hosts a show on our channel, does a really good In the Know Trader. He has a system called T-Map, which is basically three moving averages and how they're going around. Dave Landry talks about the bow ties and how they're reversing. So if you look at their work, you will see examples of this, about how the moving averages are in one configuration and they all flip. I would tell you that, especially when using the 50 and 200-day moving averages, if you look at just this example and you just looked at when they crossed, it would have said this was a buy here in early October. It's a sell there in late October, and it's back to a buy here when it's already ripped up. It's very much a lagging indicator, especially during a choppy tape. So it does not test particularly well if you look back at a lot of data. So I'm much more interested in where the price is relative to those moving averages and the slope of the moving averages. And that's what you'll hear me. You'll hear me very rarely talk about the golden cross and the death cross, even though when you go on financial media, they love to ask you about that because it's catchy. But so as tangy as super golden cross is, I would not use that necessarily as a system, but I would look at those guys. Dave Landry in particular talks about that bow tie pattern. I think it could be of interest to you. Question number two, a colleague of mine has created a chart list. How can he share that list without me having to completely recreate it? Absolutely. So if you go to your chart list, this is on your dashboard, click on the chart list button. I have a bunch of these, so sorry for that. Let's go to Grayson Rose. And if you click on it and say edit list, so wherever you're at, you just want to make sure you click on edit. So if you're looking at the list in any form, just make sure the person that has the list clicks on edit. On the upper right, you'll see this little button that says send to friend. You enter their email, and it has to be the email that their StockCharts ID, that StockCharts account is connected to. And as long as that works, you'll get a message that says, yep, confirmed it was sent. They'll get an email from StockCharts support with a link to that chart list. They can then save in their own log, and that's how you do it. Next question. This is a question for Final Bar. Please take a look at this picture from your expertise. Please help me to find where we are now. So I'm going to show this, and I'm not sure where you got it, so I won't, there's nothing on here. So, but here's exactly what it's basically talking about. The, we had a version of this. I'm laughing because we had a version of this in our chart room at Fidelity's, talking about this rotation, this traditional rotation from euphoria at the top to despair, or supreme negativity at the bottom. And the implication of this is that the smart money are sort of the early adopters of a trend. Institutions, or the broader institutional complex, sort of gets in. The public is what accelerates the trend to the upside. When we say things are new and it's going to go up forever, which is what concerns me about the chart of something like Bitcoin right now, it's sort of gone euphoric. That is tends to be where the smart money kind of gets out, and you're left with the public sort of where the music stops and things start to rotate back. So it is an idealized rotation of market sentiment and of investor sentiment. And overall, that's not a bad summary of that. Where are we now? So it depends on what you're looking at. For stocks, I would argue we're in this period. We're in this delusion. I call it euphoria, and you've heard me describe the sentiment as euphoric. Things you look for in this is when people talk about things being different and how the market can't go down because of blank, and they put in some reason like the Fed or interest rates or a vaccine or whatever. And I will tell you, having done this for 20 years, there have been plenty of times when I'm told the market's going to go up forever, and every one of those times the market has pulled back in a meaningful way at some point in the future. And so, the question is how you navigate that. And I will tell you one thing I learned at Fidelity is when the market is going vertical, you certainly want to be in it as it's riding higher. It's hard to, there's a lot of money to be made in bubble type of phases. Next question, wonderful article in the Chart Watchers newsletter. That was the one I talked about, that sentiment and euphoria. I was wondering if the rotation out of gold and silver and their miners, also out of bonds and the US dollar, would give more fuel to equities, value in particular, to make higher highs in the near term before there's no more money to push markets higher. And this was the chart you sent along. Yeah, sort of an asset allocation view. I see the S&P 500 is looking back about 3 years. You have the S&P in black, gold in pink. This is bond prices. In green, the US dollar. In brown is crude oil. So your question is, can money be rotating out of these other asset classes and into stocks, and can that provide upside? So in some ways, what you're saying absolutely makes a ton of sense. If there's capital to be rotated around these assets, bond prices can go down, gold prices can go down, crude oil can be relatively stagnant, and stocks can go higher. I wouldn't think of the dollar as an asset that's people are rotating in and out, because it's not like you rotate into the dollar and rotate out of the dollar unless you're an FX trader. But for the average investor, that's more, you use that as a cash position, but it's not, the direction of the dollar doesn't really implicate that. It's not driven by how many people own the dollar. It's more on interest rate differentials. That maybe is the subject for a much deeper discussion on currency values, but overall, so that's a little bit different. But having said, a weaker dollar does tell you what people are most likely doing about U.S. stocks versus non-U.S. stocks, and where they might be rotating, which is totally fair. So could that happen? Absolutely. I have found, if there's one thing I have learned, studying John Murphy's work, talking with John and others who focus on intermarket analysis and then analyzing them on my own, I will tell you, if you think too oversimplistically about gold goes down, bonds go down, that means money can go into stocks. It is not a one-to-one thing, and it's not like there's $100 million rotating between these different assets. It is a complex system. All of these could be going up at one point. That's what you saw in February of 2020. Go back to January, February, pretty much all 5 of these were going higher. Maybe oil wasn't actually, as I'm looking at the chart, oil was the one that wasn't, but everything else you see was appreciating into that February peak. So, and in February, all 5 of them were indeed going higher. So I don't know if you can necessarily say they're rotating in and out, but your point is well taken. And I think absolutely there's room for stock to run, especially if a value trade continues to emerge, which is what we've seen. Those are some fantastic questions. Thank you so much for sending them in. We need to wrap the show. Go to the 3 and 3 charts, 3 minutes. Here we go. Chart number 1 is the chart of Bitcoin. I actually didn't know what TG Watkins was going to show. It's interesting that he was showing a stock related, really Riot, which is tied to the price of Bitcoin. I've looked at this and seen how it's gone vertical. The breakout in Bitcoin does not surprise me, only because I think this base has been building for quite a while. You see these successive moves and breakouts above key levels. We're now in a bit of uncharted territory. We're nearing, the all-time highs in Bitcoin, which is why I think it's a key chart to watch. When things go vertical, I tend to get a little nervous about how far they can go, but overall, it's gone up a lot. It's extremely overbought. That suggests to me there is enough upside momentum. There certainly could be further upside from here. Chart number 2 is gold. Talk about something looking like the opposite of Bitcoin. Gold might be it. It's sort of like Bitcoin recently inverted, where you see the rotation lower highs, lower lows. This might have been a last gasp lower right to the 200-day moving average. I'll be interested to see what investors do with gold as it's nearing oversold conditions, nearing the 200-day moving average. In a vacuum, that's not a bad place for something to bounce. I think overall, I'm still seeing further weakness down around 157.50, but first things first, you'd have to break that key level of support, and we'll see what happens. Finally, again, my cup runneth over, looking at individual stocks, at the number of stocks breaking to new swing highs. The charts of a lot of energy stocks look pretty impressive coming off of the lows. The charts of a lot of financial stocks look even more reasonable, breaking out of their June highs. And all of a sudden, airlines look a lot like the Morgan Stanley and Goldman Sachs and other banks that sort of had that June high pulled back. Regional banks even, and now breaking it just today, closing above that June high for the first time, rotating back above the 200-day moving average for the first time since February. So as much as I hesitate to suggest airlines during a pandemic when I wouldn't think of traveling, this is certainly pricing in recovery, pricing in expectations of further upside. And overall, the trend is positive until proven otherwise. And I think that's the message you're seeing on the chart of a lot of airlines right now. Folks, that is our show for today. Special thank you to TG Watkins for joining us. We'll take the rest of the week off. We'll see you on Monday. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.